Hi, this is Jim Sackman, your Focal Point Business Coach, and this is another of our Success Friday videos. And we're talking about financing your business, and I want to talk about debt at the venture capital level, which is called venture debt, and in particular a form of early stage venture debt. Now, one of the problems that we talked about in our last video is settling on a valuation that can be agreed to by both investors and owners. And this is really a big problem in early stage companies because there's nothing or very little to base it around. There's very little progress to a product. The company has fewer, if any, customers. It's losing money, and it needs this money to get to the next stage of the business. Now, it's clearly worth more than zero, but what is it worth? So one of the ways around this is to have what's called venture debt and with a step up. So venture debt is early stage debt, and a step up is when you next evaluate the company's valuation, the amount of money that you've put in is increased by your step up. So the first real investor equity round is called an A round. And you're going to get this venture debt before an A round. So it'll be worth, let's say, $250,000 that you get in to be able to do some early development on a business. And you give them a 10% step up. So when your A round comes in, that money is now worth $275,000. So instead of the 250 it was that they actually put in, it's worth 275 in terms of the investment. So there's two ways that you can satisfy that. One is to pay them off at $275,000, and the other way is to convert their money into stock in the company at $275,000. So that's a way of getting around the entire problem of discussing valuation in these early stage companies. Now, the other thing is this loan, this debt, will have preference to it. And what that means is they're going to get their step up no matter what. In general, preferences mean they have a preferred position. They're a senior portion of the debt. Now, one of the things that's happening in this is very risky debt. And the fact is there's no money in the company to pay them off if it fails. So they're not going to get a preference in terms of payment on the reduction of assets because that would reduce their risk and make the loan simpler. What they're going to do is get a preference around the first bite at the apple in terms of the step up and how it's going to proceed into the A round and the opportunity to participate in the A round more likely. So that's a way of getting around some of the risk, providing a step up, getting people preferences so that they can reasonably give you money to get in the A round. So this is Jim Sackman from Focal Point. Change your business, change your life, and have a great day.